Imagine someone walks up to you and says,
If you had invested just $100 in the right company a few years ago, today it could be worth lakhs of rupees. Sounds unbelievable, right?
but here's the real question. What exactly is a stock?
When people hear the word stock market, many imagine a place where people randomly buy and sell shares like gambling.
Some think it's only for rich people. Others believe you either become a millionaire overnight or lose everything.
But the truth is completely different. The stock market is one of the biggest wealth creation systems ever created. Every day, trillions of rupees are exchanged, millions of people invest,
And some of the world's biggest companies raise money through it.
But here's the surprising part. When you buy a stock, you're not just buying a number on a screen.
You're actually buying a small ownership in a real company.
So how does that ownership work? Why do companies sell their shares in the first place?
Who decides whether a stock goes up or down? And how do some investors make money while others lose it? By the end of this video,
You'll understand exactly how the stock market actually works in the simplest way possible, even if you've never invested before.
so let's start from the very beginning.
Chapter 1. What is a stock?
Before we understand the stock market, we first need to understand one simple word.
What is a stock?
Let's imagine you and your friends start a small business selling handmade shoes.
At the beginning, both of you invest $500 each.
So the total business is worth $1,000 and both of you own 50% of it.
Now imagine your business becomes popular. Customers keep increasing and you want to open a factory. But there's one problem.
You need $20,000 and you don't have that much money.
So what can you do? One option is to take a loan from a bank.
But there's another option.
Instead of borrowing money, you can sell a small part of your business to other people. Suppose your company is now valued at $100,000. You divide the company into $10,000 equal parts.
Each part is called a share or stock.
If one share is worth $1, then anyone can buy it and become a small owner of your company. If someone buys 100 shares, they own a tiny part of your business. If they buy more shares, their ownership increases.
This is what a stock really is. A stock is simply a small piece of ownership in a company. It doesn't matter whether it's a small company or a giant company like Apple or Tesla.
When you buy its shares, you're becoming one of its many owners. Now you might be wondering, if companies can simply sell shares and raise money, why doesn't every business do it?
Chapter 2. Why do companies sell shares? Now that we know a stock is a small piece of ownership in a company, the next question is, why would a company sell its ownership to strangers? Let's continue with the same business example. Your shoe company is growing fast. Customers are increasing every month.
And now you want to build a bigger factory, hire more employees, and sell your products across India.
But all of this requires a huge amount of money.
You have three main options.
The first option is to use your own savings.
The second option is to take a loan from a bank, but loans come with interest, and the company has to repay that money even if business is slow.
The third option is to sell a small part of the company by issuing shares. When people buy those shares, the money goes to the company. The company can then use that money to grow its business without taking a large loan. This process of selling shares to the public for the first time is called an initial public offering, or IPO. Imagine a company offers 10 million shares at $1 each. If all the shares are sold, the company raises $10 million to expand its business. In return, the investors become shareholders. They now own a small part of the company.
But here's something important to understand.
The company receives this money only when it sells the shares for the first time through the IPO.
After that, when investors buy and sell those shares among themselves, the company usually doesn't receive that money.
It's simply changing hands between buyers and sellers. So that brings us to the biggest question.
If the company isn't involved anymore, then where do people actually buy and sell these shares?
Chapter 3. How the stock market actually works. So the company has already sold its shares through an IPO.
Now what happens?
This is where the stock market comes in. Think of the stock market as a huge online marketplace. Just like people buy and sell products on an online shopping website, investors buy and sell shares on the stock market.
In USA, the two biggest stock exchanges are the New York Stock Exchange (NYSE) and the Nasdaq National Association of Securities Dealers (Automated Quotations). These exchanges provide a secure platform where millions of buyers and sellers can trade shares every day. But can you directly go to the NYSE or Nasdaq and buy a share? No, you first need a stockbroker. A stockbroker is a company that connects you to the stock exchange through a mobile app or website.
When you open an account with a broker and place an order to buy a share, the broker sends your order to the stock exchange. If someone else is willing to sell that share at the same price, the trade happens within seconds. After the trade is completed, the shares are transferred to your Demat account, which is like a digital locker where your shares are stored safely.
The seller receives the money, and you become the new owner of those shares. This process happens millions of times every trading day, making the stock market one of the fastest financial systems in the world.
But here's the most interesting part.
Sometimes a company's share price goes from $1 to $5.
Other times it falls from $5 to $10.
Why does the price keep changing every second?
Chapter 4: Why do stock prices go up and down?
Now we reach one of the biggest questions about the stock market. Why does a stock's price keep changing every second? The answer is actually very simple.
It all comes down to demand and supply. Let's imagine a company has a share price of $1.
Suddenly, the company announces that its profits have doubled, and investors believe it will grow even more in the future. Now thousands of people want to buy the stock,
But there are only a limited number of people willing to sell it.
when more people want to buy than sell, the price starts increasing. The share that was worth $1 may rise to $1.2, $1.5, or even higher. Now let's look at the opposite situation. Suppose a company reports huge losses or faces bad news. Investors become worried and start selling their shares.
But very few people are interested in buying them.
When more people want to sell than buy, the price starts falling.
That's why stock prices move up and down all day. But company profits aren't the only reason prices change.
Many other factors can affect them, such as
Company earnings and future growth,
new product launches,
Changes in government policies, interest rates,
global events like wars or economic crises, and even investor emotions like fear and greed.
Sometimes a company is doing well, but its stock still falls because investors panic.
Other times, a company's stock rises because people expect it to perform better in the future.
In the short term, emotions can move prices.
But over the long term, a company's actual business performance plays the biggest role.
Now you might be wondering,
If stock prices keep changing, how do investors actually make money from them? Chapter 5: How do investors actually make money?
now that we know why stock prices go up and down, the next question is, how do investors actually earn money from the stock market? There are two main ways.
1.
Capital gains.
This is the most common way people make money.
Imagine you buy one share of a company for $1.
A few years later, the company grows, earns more profits, and more people want to own its shares.
Because of this,
The share price rises to $1.8. If you sell your share at $1.8, you earn a profit of $0.8.
this profit is called a capital gain.
The idea is simple.
buy at a lower price and sell at a higher price.
2.
Dividends.
Some companies don't just reward investors through rising share prices.
They also share a part of their profits with shareholders. This payment is called a dividend.
For example, imagine a company earns excellent profits this year. Instead of keeping all the money,
It decides to give $0.5 per share to every shareholder. If you own 100 shares, you'll receive $1.50 as a dividend. Not every company pays dividends.
Many growing companies prefer to reinvest their profits to expand the business instead of distributing them.
That's why some investors focus on companies with regular dividends, while others prefer companies with higher growth potential.
But here's something very important to remember.
The stock market is not a machine that guarantees profits.
Stock prices can go up, but they can also fall.
Some people make money because they invest patiently in strong businesses.
Others lose money because they buy based on rumors, emotions, or the hope of getting rich quickly.
So before investing, it's important to understand both the opportunities and the risks.
Chapter 6: Risks, Common Mistakes, and Smart Investing. By now you understand what a stock is, why companies sell shares, how the stock market works, and how investors can make money.
But before you invest, there's one thing you should never forget. The stock market always involves risk. No one, not even the world's best investors, can predict stock prices with 100% accuracy.
That's why smart investing isn't about making quick money. It's about making good decisions over time. Unfortunately, many beginners make the same mistakes.
Some buy stocks just because a friend recommends them.
Others invest after seeing a stock go viral on social media.
And many panic when prices fall, selling at a loss because they're afraid.
These emotional decisions often lead to losses.
Instead, smart investors usually follow a few simple habits.
They invest only after understanding the company.
They think about the long term instead of chasing quick profits.
They don't put all their money into one stock.
And they invest only money they can afford to keep invested for a long time.
One important thing to remember is that even great companies can see their stock prices fall for short periods.
That doesn't always mean the company is bad.
The stock market moves up and down every day, but over the long term, strong businesses have often created wealth for patient investors.
So the biggest lesson is this.
Don't invest because everyone else is investing. Invest because you understand what you're buying. The stock market is not a shortcut to becoming rich overnight.
It's simply a place where people become partners in businesses, and when those businesses grow, investors have the opportunity to grow with them.
Now that you know how the stock market actually works, you're already ahead of many beginners.
You invest without understanding the basics.
Conclusion. So let's quickly recap what we've learned today.
A stock is simply a small piece of ownership in a company.
Companies sell shares to raise money for growth, and these shares are traded by investors on stock exchanges like the NSE and BSE.
Stock prices move because of demand and supply, company performance, news, and investor emotions.
Investors can make money through rising share prices, called capital gains,
And through dividends paid by some companies. But the most important lesson is this:
the stock market is not a magic machine for getting rich quickly.
it is a system that allows ordinary people to become owners of businesses. If those businesses grow over time, investors can also grow their wealth. The key is to learn, stay patient, avoid emotional decisions, and think long term. And remember, every successful investor started with the same question:
How does the stock market actually work?
now you know the answer. If you enjoyed this animated explanation and found it helpful, don't forget to hit the like button, share this video with your friends, and subscribe to the channel for more simple animated videos on finance, business, and economics. Your support motivates us to create more content like this. Thanks for watching, and I'll see you in the next video.